Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh, and a very pleasant morning I back to our respected board of directors. As scheduled, my team and I will be presented to you regarding our findings from the financial performance between the two companies that are under the consideration to be invested to. Okay, now let me introduce my team warriors. The first presenter is Siti KHADIJAH binti MASNAWI. The second presenter is NURUL AQILAH binti ROSLAN. The third presenter is me, AFIFAH binti MUSTAFA. And the last presenter is NURUL AFIQAH binti Abdul Haris. Okay, now let's continue to our first presenter, Miss Siti KHADIJAH.
Okay, thank you, Afifah. Before we start into our main agenda, let me make a little bit introduction about the two companies, which are Johore Sdn Bhd and also Kawan Sdn Bhd. We start with Johore Sdn Bhd. Johore Sdn Bhd, which mainly located in Johor, was incorporated in Malaysia since year 2000 as a public limited company. As for 2003, Johore Sdn Bhd was listed on the second board of Bursa Malaysia, but then in 3 years later, Johore Sdn Bhd was transferred into the main board of Bursa Malaysia. Currently, Johore Sdn Bhd consists of 3 main reporting segments. Johore Sdn Bhd primarily engaged with the business of investment holding. As for the other 2 segments, they are the subsidiaries companies which engage in the manufacturing of tin can and also food and beverage. As for 2020, Johore Sdn Bhd consists of 4 wholly owned subsidiaries. Alright, next let's move on to Kawan Sdn Bhd, which mainly located in Selangor. Basically, we can say that Kawan Sdn Bhd is the senior company to Johore Tin, as they already operated for 42 years since 1978. Kawan Sdn Bhd is one of the Malaysian leading exporter and also the largest manufacturer of frozen food. As same as Johore Tin, Kawan Sdn Bhd is also a Malaysian-based investment holding which involved in the manufacturing, selling, trading and also distribution of frozen food. Under Kawan Food, they have 5 subsidiaries companies. Okay, next let's move on to our main agenda. Profitability of a company is the major concern for us as an investor to go through before we decide on which company is worthy to be invested to. Profitability of a company measure how well they generate income respective to their sales, operating costs, and also in terms of paying tax. To deal with that, let us review the profitability ratios from the both companies, Kawan Sdn Bhd and also Johore Sdn Bhd in 2018. From our analysis, we have seen that Kawan Sdn Bhd has better margin ratios compared to Johore Tin. This indicates that it is more profitable for us to invest in Kawan stock as they are worthy in money making. Okay, now let's take a short look at the operating margin from the both companies. From our analysis, we have seen that Kawan Sdn Bhd is better than Johore Tin in terms of managing their costs. From this, we can predict that Kawan Sdn Bhd has better chance to survive during slowdown as they are well occupied to pay for their fixed costs. Okay, as for obligation after paying tax, Kawan Sdn Bhd is still a step ahead compared to Johore Tin. But as you can see from the table, there are not much difference between the two, as Kawan Sdn Bhd is only lead by 4% from Johore Tin. Okay, actually, as we can see from the table, the difference of the margin ratios between the two companies are slightly small, which below 10%, except for the gross profit margin, which Kawan Sdn Bhd is leading by 16% ahead compared to Johore Tin. From this, we can predict that Kawan Sdn Bhd is better to converting their sales into profit compared to Johore Tin. Alright, to wrap with my point, I can see that it is more convenient for us to invest in Kawan stock as they are further successful in generating profit. Alright, next let's move on to our next presenter, HUDA AQILAH. Thank you. Okay, the next ratio that we analyze is liquidity ratio, which measures the company's liquidity and the ability to convert their current assets into cash quickly and cheaply. Okay, first, let's take a look at current ratio. Okay, current ratio is one of the liquidity ratio that measures how many times the company can cover their liabilities. A quick analysis of current ratio is that Kawan's company is a little bit better than Johore, since the difference between them is only 0.92 times. This shows that Kawan company has a better liquidity position and the ability to pay off its current liabilities within 1 year with their current assets such as cash, account receivables, and inventories. Okay, next, quick ratio. The quick ratio measures that how many times the company can cover their current liabilities without selling any inventory, and so it's a more stringent measure of liquidity. From our analysis, we can see that Kawan company has a higher quick ratio that are rather than Johore company. This shows that Kawan company has more quick assets and enough to pay their current liabilities. Quick assets such as cash and cash equivalent, marketable securities, and short-term receivables. There are current assets that can be converted too easily into cash. And now for the asset management, we move to the account receivables turnover ratio. We analyze that Johore company has a high ratio, which indicates that the company's collection of account receivable is efficient, and it has a high proportion of quality customers that pay their debts quickly. Not only that, Johore company also takes a shorter times to collect their receivables rather than Kawan's company, which shows that it has better management towards their receivable. From this analysis, we conclude that Kawan company is the best company to be invested if we look in the term of liquidity. Even though Johore company has higher receivable turnover ratio and low average collection period, but customers must pay this company rapidly, perhaps too rapidly. There's a downside to this, as it may indicate its credit terms are too strict and can lead to losing customers. In other words, Kawan is better, as customers may seek to supplier and service providers that has more lenient payment system. Okay, next we move to the part that most of the investors are aware of, which is leverage ratio, company leverage ratio. The financial leverage ratio, also known as equity or debt ratio, it is a key to measure the company solvency and mainly focus on the long-term ability of a company to pay off its liabilities and to tell about the company dependency on borrowing. If the business can obtain higher return than the debt is owed, the business is said to be less leveraged. If it is highly leveraged and this situation continue for a long time, it may lead to bankruptcy. Okay, let's move on to the debt ratio. Debt ratio is one of the leverage ratio that measure the ratio of a company total debt against the total asset. As we can see that Kawan's company has a lower debt ratio compared to Johore company. This shows that Kawan company is less leveraged and has strong equity position, and also it illustrates that Kawan's company has good financial health. So the lower the company reliance on debt for asset formation, the less risky the company is, as it have less debt repayment burden, and vice versa. The debt ratio is fundamental in business solvency ratio, as it measures the financial stability of the company. So from the analysis, we all think that Kawan is the best company to be invested. So That's all. Thank you. I will pass to one of my team, which is AFIFAH. Thank you.
Okay, now I will proceed from the previous presenter on debt management and future prospect. Okay. When we analyze these two companies, we have seen that the ratio of Johore is higher than Kawan. What can I say is Johore is very patient in finance their growth by making loan. Only then they can provide more capital. And for sure, this loan will charge an interest. Johore they need to pay back both the loan and interest. Even though Johore managed to make more profit, but they need to pay the loan plus interest. So at the end, they will not gain too much. Unlike Kawan company, they have lesser debt. So the profit that they can earn can be used to grow their capital without making loan. Even though they are intend to making loan, they will not be burdened by it because they still manage to pay the loan and the interest. Even during the economic downturn, they can still survive and manage their company. Dear Board of Directors, I guess all of you have already known that when PE ratio of one company is higher than the other company, it means that that company has more potential. From our analysis, Kawan company PE ratio is 13.13, while Johore is 8.23. Okay, you can see from the slide shown the PE ratio of both company. Okay. Kawan has higher ratio compared to Johore due to their higher earnings per share. High earning per share is a sign of better earnings and strong financial position. Thus, we can expect expecting earnings growth in Kawan company because we can see that this company is doing very well and worth in investing. So we can consider in investing in the Kawan company. Okay, now I will pass to my friends to conclude it.
Thank you, Ms. Afifah. Now I will conclude the details that have been mentioned by previous presenter with the SWOT analysis. I had divided the SWOT analysis into their respective company. First and foremost, this is Kawan SWOT analysis. These are the list of Kawan's strength, weakness, opportunities, and threat. Okay, firstly, the strength of Kawan, they actually can help our company to be recognized because Kawan is one of the well-known manufacturer of ASEAN food delicacies that they are acknowledged by lots of people. We can use these opportunities to promote our company through this investment. Then, regarding the weakness of Kawan, they are actually manageable because the issues are regarding reliance on raw material and also high investment on machinery. So they can just limit the usage of raw material and also the machinery and use the existing one efficiently. Okay, next, the trades come with opportunities. We can actually use this trade as opportunities to make new strategies to recover the well-being of the company that we intend to invest on. Okay, now this is a SWOT analysis of Johore. Okay, the strength of Johore is they are better in Kawan regarding managing their risk because they have very excellent risk management team. So we do not need to worry about the risks that might arise later on because they are very experienced in this aspect. Then, regarding the weakness of Johore, they are actually manageable if and only if they gain high profit because they can use this profit to construct their company structure. Okay, lastly, regarding the trades and opportunities, they are actually quite same with Kawan. So we can use the same method as Kawan, which we can use this trade as opportunities for us to expand their company. Okay, our research comes to conclusion, which is the best company to invest on is Kawan because they give us high profitability, they are solvent company, they can manage their liabilities well, and also they have bright future prospects. That's all for today's presentation. Thank you for lending us some time.